Kitco News, special coverage of the New Orleans Investment Conference, is brought to you by Uranium Energy Corp and U.S. GoldMining.
Hey everyone, welcome back to Kitco News. I'm Jeremy Szafon. We, of course, are excited to be on location at the 50th anniversary of the New Orleans Investment Conference here in beautiful Louisiana, where it is a beautiful day. My next guest says the Fed does not need any more interest rate cuts. You know him well. Jim Bianco is here with us to dive into what this means and what we can expect from the upcoming meeting. Great to see you.
Thanks for having me.
It's been quite a time. Obviously, we had you on a couple of months ago. Since then, we've had 75 basis points being cut since September. Investors are split, more or less, 50-50. CME FedWatch tool saying next meeting in December, we might see another 25. You say no. Why?
Yeah, I mean, you're right that the market is right on that 50-50 line right now, whether or not we're going to see another meeting. When we're talking about the Fed, there's always two questions, right? What will they do? And what should they do? What will they do is whatever the CME tool tells us. What they should do is not cut anymore. They cut on, starting in September on the idea that the economy was slowing, that inflation was coming down, and that there was some potential problems in the labor market. That has not come to pass over the last 3 or 4 months. Now you throw in a Trump victory, the potential of tax cuts, deregulation, which is very stimulative, and tariffs, it's not necessary. And all a rate cut could wind up doing is fostering more inflation fears. And that's why I think it's important to note that since September 18th, when they first cut 50 basis points, the 10-year yield is up 80 basis points. That's the biggest rise we've seen in the 10-year yield following a rate cut ever. It is a signal from the market. You shouldn't be doing this. Now, Jay Powell was asked that in his press conference earlier this month, and his answer was, we don't know why the yield is going up. And when Chicago Fed President Austin Goolsbee was asked last week on CNBC, why is the 10-year yield going up while you're cutting rates? He literally said, the Fed's got to figure this out. Yeah. I think they know why. They're uncomfortable with saying it out loud right now, that the market is telling you it's not a good idea.
You think Jerome Powell, the Fed chair, was surprised that Trump got in? I mean, there was a lot of talk about being very politically neutral, even with the rate cuts. Now we're sitting here going, okay, maybe there's a pause.
He shouldn't have been surprised, because throughout this entire political campaign, if you follow it, even reasonably close, you should have known that it was going to be a close election. It was very possible either one of these was going to win. Don't confuse this with 2016, when Trump shocked the world by winning the election. So he shouldn't have been. I think really what he was more surprised by was the unemployment rate. That, I think, is what moved him. The unemployment rate a year ago was 3.5%. It went to 4.3. It triggered that, Psalm rule indicator that said that we might be going into recession. The Fed reacted. I think what we've learned, or what we were learning when they did that, was the reason that the unemployment rate went up, traditionally you would say people are losing their jobs. Right. That's why the unemployment rate is going up. But what we're learning is, in Fed's parlance, is we got excess labor supply. The population of the country is increasing because of migration, and a lot of those migrants are unemployed. They're getting picked up in the survey. The unemployment rate is the number of unemployed people divided by the number of people working. The number of unemployed people is growing faster than the number of people working because the population is adding more unemployed people. That's excess labor supply. That is not necessarily a reason to be cutting rates like a traditional reason where people are losing their jobs and you want to try and stimulate them back into work.
The past 6 months, we've seen revisions, huge revisions to any of the data coming out. Have people lost, not interest, but faith in the Fed?
I don't know if they've lost faith in the Fed. They might have lost faith in some of the data, because the unfortunate thing about the data, I understand why we've seen the revisions, and boy, we should probably going to see some big ones in the payroll report. Remember, it was 10,000 jobs because of the hurricanes, because the way it works is it's a survey. If you don't respond to the survey, they put you down for 0. If you respond to the survey the following month, they add you back, so there should be big revisions. So I think people are losing faith because we live in a conspiratorial world. Right. It can't be that it is just the noise and the nuance of trying to do a large population survey. It has to be somebody putting their thumb on the scale for a political goal. And that's where I think these revisions don't help to dissuade people from thinking that way.
Yeah, Jim, I mean, we have $36 trillion in debt. What do you say to the people that think that the Fed is doing this just because they need to service all of this?
If they are, and I don't think they are, it would be a catastrophic error. Now, Jay Powell has been asked this question many times, and the phrase that the Fed uses is called fiscal dominance, meaning that the $36 trillion is now going to dominate monetary policy. Jay Powell is 100% correct when he says, that's not my job. There's a president, there's 100 senators, and there's 435 congressmen. It's their job to fix that problem. My job is to set monetary policy based on where I think inflation and employment are going to go. If I think that the answer is to raise interest rates, and you turn to me and say, but isn't that going to raise the cost of debt? Yeah, well, go talk to those 536 people in Washington. They have to fix it, not me. I think that's 100% correct in the way to look at it. If the Fed is saying, I can't raise rates because of the debt, then at some point we're going to get inflation. And then he's going to say, I can't raise rates because of the debt, the bond market's going to collapse. Yeah. If we lose confidence that he's fighting inflation because of the debt, then we're going to have bigger problems on our hand.
Okay, so we talked about the CME Fed Watch tool split, that 50-50. What happens if the Fed doesn't listen to you? What happens if they do go ahead and cut in December? What's going to happen? What's the long term here?
The fear is that if they continue to cut, the market will continue to say, too much. We don't need this. You're overstimulating, you're creating inflation. We got to 450 on the 10-year note yield last week. You cut again, we could see 475 or 5 if the market thinks it's too much. That's the risk they face. The Fed wants to cut interest rates to stimulate the economy. All they've done is produce higher mortgage rates. They've been a drag on the house, because that's the most immediate channel is mortgage rates. They've been a drag. It's interesting because really it's a confidence game. As we talk right now, the 10-year yield is at 440 and the Fed is easing. In 2022, when we got to 9% 10-year note, 9% inflation, the 10-year yield never got over 420. Why is it higher today than in 2022 when we had 9% inflation? Because the Fed was raising rates 75 basis points a meeting. Jay, you're going to fight this inflation by raising rates 70 every meeting? I don't have to worry about the bond market. Jay, you're going to be cutting interest rates when Trump's about to come in and stimulate, when the economy's fine, when we're about to get tariffs. I'm very worried about the bond market. So ironically, you want lower long-term yields? Raise rates. Yeah. You want higher long-term yields? Cut rates. That's what we've seen over the last couple of years.
Yeah, it's been fascinating to watch. Okay, well then give me your Fed outlook. Obviously, we just talked about it. We have the Trump presidency. It's kind of American first stance. There's going to be some liquidity likely coming into the market. Where are we at? What's your outlook for the Fed next year?
It's going to be fun. In other words, what I mean by fun is it's going to be, I think the Fed is going to stop very soon. If not November, that they're already done, December might be the last rate cut because the economy, the stimulus will be too much, they'll stop. What I mean by the fun part is once they stop, the next thing that'll happen is Trump will say, I'm going to fire you, and Jay Powell's going to say, you can't, and he's going to barricade himself in the office and say, I'm not going to leave, and Trump's going to say, I'll send SEAL Team 6 in to remove you, but he won't. Yeah. He won't. Jay Powell will serve his needs much better as a whipping boy by saying, you're the problems everybody's having. You're making everything worse. I want to fire you. Just like he did in 2019. He kept threatening to fire him every other week, but he never actually did it. Powell's term is up in May of 26. Yeah. He should know that not only is he not going to get reappointed under Trump, he probably wasn't going to get reappointed under Harris. Harris was probably going to take somebody like Lael Brainerd or somebody of her thinking to put into the Fed. So he knew he was going to be done in May of 26. So I think the Fed will be done. I think the tweets will be entertaining. And the reason I say that in such a flippant way is we've got history with presidents being mad at Federal Reserve chairmen. Yeah, Trump made me tweet at Powell, but Lyndon Johnson in the 1960s, took Bill Miller and literally threw him against a wall, physically assaulted him and said, boys are dying in Vietnam and Bill Miller can't cut interest rates. So mean tweets are kind of mild stuff compared to what we used to do to Fed chairmen.
Does it mean we're at risk of a recession in the U.S. next year if this continues?
I don't think we're at risk of recession because I think at this point we're more at risk of overheating and more inflation. And I hate to say it, but that might be worse than a recession. There was a survey recently done by Americans, and they said if the unemployment rate had to go up 1% so that the inflation rate could go back to 2%, the overwhelming majority of Americans said do it. Sorry, you 1.5 million people that have to lose their job to get the unemployment rate up 1%. But the other 300 million of us want a 2% inflation rate. So, no, I don't think we're in risk of recession. I think we're fine. I think unfortunately, the bigger problem might be sticky inflation. Okay. That's going to be a bigger issue. Last thought for you, people said when they elected, right, they think the economy's terrible. Yeah. And economists will tell you, but every metric says it's not. So why do they think it's terrible? The cumulative rise of prices over the last 4 years is what they think is causing the economy to be.
So that dual mandate that we're talking about, I mean, we're more in a risk of the inflation side as opposed to employment.
I think so. At a time when the Fed is telling you, no, the inflation problem's been solved, we have to focus on the employment. I think they're premature in that. They should be considering continuing to look at that inflation side.
Right. Let's go back to the bond market. What's it telling you here?
Same thing. I mean, the rise in yields is basically telling you that they're worried about inflation. Within the bond market, I'll use a fancy word, a bear steepener. The yield curve is steepening, meaning short rates are above long rates, but they're both rising with long rates rising faster. That is a rare situation. Mm-hmm. That's another signal that we might be overheating, and that's another thing that you're seeing in the bond market. The other thing you're seeing in the bond market, corporate spreads are at multi-decade tights. That is consistent with the valuations you're seeing in the stock market, that it's the valuations are very tight in the stock market. The phrase is price to perfection. Corporate bonds, are they at risk? No, but a lot of things have to go right. Say mortgage bonds, which have a much wider spread, probably have a better value to them.
Okay, what about the gold market? I mean, we've been talking about all-time highs all year. After Trump, the presidency, we saw that 18% dip starting to come back, $2,600, $2,700. If the Fed goes ahead and cuts next month, is gold going to go up?
Yeah, we've got an interesting situation this year that you're looking at with 5 weeks left in the year. Yeah. That the stock market might be up 25% this year, the S&P 500, and gold might be up 25% this year. When was the last time both went up 25% in the same year? Zero. It's never happened before.
It's weird.
So what is that telling us? I think that if there's a commonality that's got stocks going and it's got gold going, it's easy monetary policy. Mm-hmm. Easy monetary policy, liquidity, juice stocks, they go. Easy monetary policy, we're not quite through this inflation problem. The hedge against, gold is not just a hedge against inflation. Mm-hmm. Gold is a hedge against anything bad that might happen. It's but one of those bad things is inflation. And I think that if you were to think about why gold is going and why stocks are going, and you're having this unusual situation where both stocks and golds return you 25% in the same year, it's easy policy. In other words, the Fed keeps telling us they're restrictive. The Fed keeps telling us they got to cut hundreds of basis points to get to neutral. But the market response is not that. The market response is you might be at neutral right now. The market response is you keep cutting rates, you're going to go too easy. And that's what gold is sniffing out. And of course, stocks love liquidity. And that's really, they're liquidity animals, and they're just driving with liquidity.
There's been a lot of younger investors going towards the Bitcoin audience too, starting to hedge on that safe haven bet. Has anything surprised you here, or is it more that people are understanding that you need an asset mix?
I think what surprised me is the 50% rise in the last 2 weeks. Yeah. We forget that, gold was $60,000 when Trump was elected. And here we are not even 2 weeks later, and it's on the door of $100,000. So it's been a big rise. Look, I understand the argument for gold. For Bitcoin. Mm-hmm. I understand the argument for Bitcoin. I own some. Mm-hmm. And so I'm not against that argument. What I am against is this idea that we're going to go, to take Michael Saylor's argument recently, that in 20 years we're going to be at 13 million. Okay. What is the scenario that gets us to 13 million? That, by the way, that puts Bitcoin's market cap at $250 trillion, more than the market cap of the world economy and the world stock markets combined. Mm-hmm. Why would Bitcoin get to that? Hyperinflation. Is that we basically collapse the existing financial system in order to hyperinflate into some new financial system like Bitcoin. Okay, that is an argument that a lot of the Bitcoiners make, but what I'm afraid of with that argument is twofold. One, we're not going to like the world if that's what we're going towards. Right. Two, the day, what can you buy for $100,000 today? You could buy a top-end model Mercedes. When it gets to 13 million, what are you going to be able to buy? Probably a used Honda for $13 million. Yeah. That's what happens when you have hyperinflation. The Bitcoiners think it's going to go to $13 million, and tens of thousands of us are all going to go buy $15 million beach homes in the Hamptons. There's only a few hundred of them, and they're going to be several $100 million in that environment, if not $1 billion.
So we're almost at 100,000 on that side. Are we hedging against it? Where's your bets? What's your outlook there next year?
I don't know about the price, but I will say this. 100,000 is critically important because the narrative in the crypto community has been, with the advent of the ETFs, here come, to use their terms, here come the normies. Now they've got a tool in the ETF that they can jump in without having to get an electronic wallet in order to buy Bitcoin. And their argument is, when we get over $100,000, we're all going to FOMO. So when we hit $100,000, probably 10 minutes after this interview is over.
Yeah, exactly, always.
The stock market's going to collapse. The bond market's going to collapse. The gold market's going to collapse because all that money's going to get sucked into Bitcoin because it's this giant FOMO. Yeah. We'll see. Yeah. We'll see if we get the FOMO. What I'm arguing is we might get to 105,000. They're going to look around and go, nothing's changed. Yeah. There is no FOMO. So you hyped it to the FOMO level of 100,000. And then it didn't materialize. And then we might start looking at valuations, and we might start looking at rates of change, and then proceed to be correction. Yeah. The reason, by the way, I don't think you're going to get a FOMO is my experience is gold's up 30%, stocks are up 24%. Okay, Bitcoin's up 120. The Bitcoin community thinks that the guys that are owning stocks saying, crap, I missed it. It's up, I'm only up 24%. Or the gold people are going to say, I'm only up 30%. I should have been in Bitcoin. No, they're going to say, I'm up 24%. I'm having a good year. I'm up 30%. I'm having a good year. Good luck to you with your 120% gain. Yeah. If they were down and those were and Bitcoin was up 100%, that might be a different story. Yeah. But people never complain about an extraordinary year saying it should have been more extraordinary. I got to get out of this investment that's working for me to get into this other speculative investment that's going up faster. Human nature doesn't usually work that way.
Yeah, well said. Psychology too. Okay, I have to ask you, because Japan and China, two of the largest holders of U.S. debt, are making bold moves in the Treasury market, as you know. In the third quarter, both nations dumped billions in the U.S. bond just ahead of Donald Trump getting in, raising questions. What's driving the sell-off? What's it going to mean for the global markets here?
I think that there's two different stories going on. China, you think of it as a conveyor belt, right? We buy a lot of goods from China. We pay for those goods with dollars. Well, what do the Chinese do with these dollars? They park them back in the treasuries. So we send money, they send goods, they then reinvest in treasuries. Our trade deficit with China has been slowing. Their economy has been slowing. That's one of the reasons why they're not buying as much treasury debt, because we're not buying as much stuff from them. It's not a conscious decision in any way. The Japanese have replaced the Chinese as the largest foreign buyer. Their sell-off was their currency. They had to defend their currency by selling dollars to buy the yen when the yen was weakening. So it was more of a tactical move, and I don't think it was anything to suggest a longer-term shift. They'll continue to probably be big buyers. I don't think they were considering that Trump was going to win. Mm-hmm. They were looking at their currency falling, and they were saying, we have to try and defend it. Yeah. And there's a ready stock of sell these dollars to buy yen. And when you sell the dollars, you have to sell treasuries.
Yeah, it's been crazy watching the yen too. Okay, well, I know you got to get to the stage. So Jim Bianco is the president of Bianco Research. Great to meet you finally in person as opposed to these remotes.
Yeah, enjoyed it.
Appreciate it. I'm Jeremy Szafon for all of us here at Kitco News. We're going to be here all week long, so keep an eye out for us, and we'll see you next time.
Kitco News, special coverage of the New Orleans Investment Conference, is brought to you by Uranium Energy Corp and U.S. GoldMining.